Joseph, thank you so much for coming. Our whole Turkish audience, they know you by now. And that's why I call you Joseph, if you allow me.
Sure.
And you were in the international Bloomberg studios, I mean US TV,
Yes.
just 5 minutes ago. Now you're here. Thanks again. You talked about the housing sector because we had important economic data coming out this morning. What were they? S&P Case Shiller, and it's 8 years high. Is it good for you? Are you satisfied with that number? Because it is, the last time we saw it was 8 years ago.
Right, so we're seeing continued price appreciation in the home market. Now that's a very positive development because what it does is it makes consumers a little bit more confident in their ability to maintain current levels of spending. If your house price goes up, you feel a little bit wealthier. Plus the fact that we had such a major crash between 2007 and 2011 that it's fitting that we're beginning to see some recovery in the housing sector.
So you're happy?
Yeah, I think more importantly, the building permits data this morning suggested that we're going to see an acceleration in residential construction, which of course bodes well for fourth quarter GDP. Now, the fourth quarter GDP in the United States is likely to be around 1.5%, mostly due to the government shutdown and a likely correction in inventories having to do with a weaker holiday spending season.
So let's say it slowly for our audience. Your GDP growth estimate is
1.5%. As opposed to what we're in the third quarter, we're likely to have 3.2%. And what happened was a lot of the factories pulled forward orders well ahead of the holidays, so we got a real big inventory build. Now what has to happen is the consumer really has to hit the accelerator on spending in order to absorb that, and they're not going to do that, unfortunately. No.
But Joseph, Thanksgiving is around the corner.
Sure.
Christmas sales, majority of the sales, like you said earlier, is, you know,
between now and New Year's. That's right. Yeah.
So you're not expecting a nice increase of sales during that time in the retail?
This is a familiar narrative when we talk that we have a tale of two economies here in the United States. The upper two income groups, roughly 40% of all households, well, they account for 60% of all spending. They're going to do quite well. They'll spend a lot. But the lower three income groups, well, they're having still a bit of a problem adjusting to the structural change in the U.S. economy. We did hike taxes this year at around $150 billion, which they had to adjust to. And then right now what we're seeing in the pipeline is if you look at wholesale gasoline futures, they're signaling an imminent 5% jump in gasoline prices. What that translates to...
Wait a minute, because the gas prices have been going down because of the Iranian agreement, you know, the
Well, that was temporary.
stability.
That's gone now. It's been reversed after less than 48 hours.
It's been reversed. So
Already,
we're going to see a pickup, an increase in the gasoline prices.
That's correct.
How much of it, and, you know, until when, let's say?
Well, what we typically see this time of year is a seasonal increase in prices, but it's jumped out, it's a little bit sharper increase than what we normally see. Okay, let's translate that into what that means for the economy. That means we'll have roughly about $40 billion less in personal disposable income to spend. And of course, people in the lower three income groups, well, demand for gasoline is what we call inelastic. They can't adjust, they just have to absorb the hit. And that leaves a little bit less in their wallets to spend on Christmas and holiday items. So what that means is we're going to have trouble meeting the expectations for holiday sales this year, which the National Retail Federation said should be about a 3.9% year-over-year increase. I think 2 to 2.5% looks about right to me.
So not 3.9% increase, but you're expecting
2 to 2.5%.
That's a lot. That's still a lot.
Well, it's good. It's better than having it contract, which is what we saw around the recession. But historically, we tend to see much stronger increases in year-over-year holiday spending. So the consumer or the U.S. household has yet to really bounce back from the recovery. And that's why we have a bifurcated economy and a two-track model.
I want to bring we started with the housing sector. So I want to bring our whole conversation back to the housing sector. Yes, I mean, the U.S. home building permits hit 5-year peak last month and 8-year in terms of the prices in 20 cities. But yesterday, we saw, you know, the pending home sales, not 1%, but minus 0.6. It wasn't as high as it was expected, even though it was a 5.6% decrease in September. It was still good, but not as good as it was expected. So in the housing sector, do you see a recovery in certain areas and some lagging in certain areas. What is your whole opinion about the
All right,
picture in
so
housing?
here's what I see is we have an organic and sustainable increase in residential investment. We built about 4 times as many single-family residencies as we did multifamily dwellings during the bubble. And what we're seeing is a build-out in apartments, co-ops, and condos. And that will accommodate young people who are now moving out of their parents' house or basements into their first home, and the millions of people in transition from home ownership to renter status as the U.S. home ownership rate declines. Okay, so that bodes well. We've got a long ways to go, and I think we've got a multi-year recovery that's ongoing in residential investment. Okay, now if we're looking at existing home sales and home ownership, all right, sales are likely to slow somewhat as interest rates rise. When we had the 150 basis point backup in long-term rates between May and September, that hit interest rate sensitive sectors in the economy, excluding autos, which tended to do quite well. We did see housing slow appreciably. Now, what we're seeing is the lagged impact of the leveling off of rates. Here's what's key, Melike. If the Federal Reserve continues to signal to the market that they intend to reduce the pace of its own asset purchase program, you'll tend to see the 10-year rate migrate up and the 30-year mortgage rate follow it up or move up along with it in tandem. If that occurs, then you will see home sales slows and price appreciation slow. So we're at a very delicate time in terms of the intersection between the fundamental economy and major policy decisions, and these are likely to shape the entire year of 2014.
I'm glad you mentioned that, Joseph, because I want to bring this to that area. The impact, we're talking about the impact of the good economic data have been bad on the U.S. equity markets. But since Thursday, we've seen a healthy shift. Can I call it healthy, by the way? Because we had good unemployment data, we had good, sales. So we said, I think we are going in the right direction. So we've been seeing greens and record rallies in the U.S. equity markets. Is this healthy? And do you think Fed is going to wait until March 2014, like all the Bloomberg economists, I'm sure you're one of them, says that the tapering will happen by March 2014? Do you think there's a trend towards that area right now?
First, on the latter question,
Yes.
I think March 2014 is the earliest they can go. Remember, early next year,
Not before,
not before,
in
no,
December.
we're not going to have a December, we're not going to have in January. Early next year, the U.S. Economy will face the fiscal follies again. Washington's going to have to sign on a budget and to raise the debt ceiling. If there's any turmoil surrounding that, that just pushes back the decision on the first date of the taper. Okay, that's first and foremost. Second, my sense here is there's a couple things that are supporting the equity markets that are not sustainable. First is it's the Fed purchases. Second, large U.S. multinationals that have very clean balance sheets, the best they've been in history, are choosing to use the cash that they have to buy back stock, not invest in capital expenditures, which then leads to an increase in jobs. So I'm not comfortable with that. Now, that being said, we did see a little bit better data over the last couple weeks, and I think that may have turned investor sentiment towards, well, next year in 2014, growth's likely to be a bit better. Things are going to be looking much better across the broader section of the economy. And I think that might have whetted the appetite to take more risk onto their balance sheets. But it's a very delicate interplay between expectations that things are going to get appreciably better and then what's really driving it, which is the Fed purchases and the stock buybacks by these big companies.
I want to ask you more about the stock buybacks another time. Our time is up here. It's a very interesting topic. I want to know where that report comes from, but I like to hear you positive and a little bit bullish in terms of the equity markets.
Yeah.
Good to have you. Thank you, Joseph.